What's up guys, it's Ezekiel Chiu here, and today we are going to show you if there is only one candlestick pattern that I will use to trade with. This is the one. So this candlestick pattern allows you to not just get into reversals at the highest or the lowest points, but also allow you to capture trend continuation perfectly in a trending market. So in this video, you will learn what is a doji candlestick pattern, the 3 different types of doji candlestick pattern, and how to spot and trade highly profitable trading opportunities using this candlestick pattern. So, what exactly is a doji candlestick? I mean, to put it simply, a doji pattern occurs when the opening price and the closing price of a candle are the same. So, essentially, it creates a candlestick with no real body. I mean, just a straight line. So, while the highs and the low points are still visible, remember, there are different types of doji patterns, which is something that we will cover in a while. But before that, let's address a common mistake when you are trading the doji candlestick. You know, pretty often, traders would see like, hey, the market is trending upwards, and then they encounter a doji candle. And that's where they assume that, hey, since the buyers and the sellers seems kind of like balanced, the trend might reverse downwards. However, it's truly not that simple. I mean, a doji indicates temporary indecision in a market. It is not a full-blown trend reversal yet. So it's not going to be easy for just like one doji candlestick pattern to reverse an entire trend. So relying solely on a single doji to reverse an entire trend is probably not the wisest move of them all. So avoid the mistake of going short. I mean, simply because you see a doji in an uptrend. Remember, the trend will likely continue despite the presence of a doji. So you got to be mindful of this. Now that you understand that, here are the 3 different types of doji. The first one, it's called the Dragonfly Doji. So similar to the standard doji, the open and the close price are the same. However, the Dragonfly Doji also features a longer wick, indicating a rejection of lower prices. So here's what it looks like. You can see that this is a Dragonfly Doji. It shows what? Rejection of lower prices as the market open, drop. But buyers push the price back up, closing at the same level as the open. So essentially, this indicates rejection of lower prices. And this suggests what? The buyers has intervened, pushing the price higher after it dropped. So this candlestick pattern is a sign of what? Strength. Because the buyers at the last minute push the price up higher. So how can you trade the Dragonfly Doji? When trading candlestick patterns, it is important to consider the market context rather than just solely relying on the pattern itself. There are what? 2 types of market conditions to look for when you are trading the Dragonfly Doji. First one, when you trade the Dragonfly Doji at support levels, right? This can be really effective. You got to remember, understanding the meaning behind the pattern is really crucial. A Dragonfly Doji occurs when the open and the close are at the same level, creating a long lower wick. So if the body of the Dragonfly Doji is small and the open is only slightly below or above the closing price, it is okay. It still indicates potential bullish reversal, especially when it appears at a good support level. In this case, the candlestick has what? A small body with the open slightly lower than the closing price. Now, some traders might call it a hammer. It's still considered a variation of a Dragonfly Doji. So what is important is understanding the meaning of the candlestick pattern rather than you being caught up by all the different kind of definitions, right? So instead of memorizing every candlestick pattern, focus on understanding their meaning and their potential different variations. Trying to remember, like say, hundreds of patterns, their terms, their names, etc. I mean, it can be really overwhelming and really not very practical. It is more important to understand the concept of it and recognize how patterns may vary in different market conditions. Here's an example of a variation of a Dragonfly Doji. This occurs at a what? At a support level, where price rejected lower levels and then closed slightly higher. Now, it rallies up higher, back into this swing high and towards the resistance area. That's where you can consider going long. However, when setting your stop loss, avoid placing it directly below the low of the Doji candlestick. I mean, this could lead to you being stopped out kind of a little bit too easily. Instead, what could be good is that you provide some buffer and then place it slightly below. So around this level. You can place it somewhere here. If you are a swing trader, you can look to take profit at where? At the nearest high or at the resistance area. Alright, so this is one way where you can look to trade this Dragonfly Doji, otherwise known as a hammer. Now, an alternate way to trade the Dragonfly Doji is when the market is in an uptrend. So this is what? This is trend continuation. Earlier was a reversal. So if you observe that the market constantly bounces off the 50 period moving average, for instance, right? So whenever it retraces to this moving average, do know that it can be any moving average, right? In this case, we say it's a 50 moving average, right? It indicates that area is an area of value. So this represents a potential buying opportunity. So in this scenario, we are technically looking at a hammer pattern, which is essentially a variation of a Dragonfly Doji. So the price approaches forming an entry signal for a long position upwards. So this is a trend continuation using the Dragonfly Doji. Your stop loss could be placed slightly below the swing low, providing a buffer for market fluctuations, spikes, right? So profit taking can be placed at the nearest swing high, or you can adjust it based on your trade management strategy. If it's trend continuation, you can place it at a swing high, you can do trailing, you can set a fixed TP based on a resistance area. When you are able to identify a good Dragonfly Doji, although it doesn't happen often, when you see one, which it does happen regardless of whatever vehicles that you're trading, whether it's Forex, stocks, crypto, commodities, etc., it's there. And you're going to notice that, hey, if the last time round it worked, there's a very good chance that this time round it's going to work as well. The next Doji candlestick pattern, this is now what we call the Gravestone Doji. Similar to the Dragonfly Doji, the Gravestone Doji also have the same opening and closing prices. However, it is characterized by a long upper wick, indicating rejection of higher prices couldn't come back down. So this is how it looks like on the chart. The Gravestone Doji shows the open and a close at the same level with a long upper wick. This means what? Initially, the buyers were in control, pushing the price upwards. But then the sellers took over and then drive the price down to close near the open level. So variations of the Gravestone Doji would include instances where the market opens higher, indicating a bullish momentum initially, but then sharply reversals down to close near the open or even lower. So we can have this leeway, okay, forming a bearish pattern because now the closing is lower than the opening, which is good. This variation demonstrates what? Rejection of higher prices, signaling potential weakness in the market's upwards momentum to potentially head downwards. Since this is a rejection of higher prices, you want to look for what? Confluence at levels where the selling pressure could exist and be there. So for example, this is an area of resistance. And then Over here, you have the variation of a Gravestone Doji. We now know that, hey, the market has rejected higher prices and then closed near the lows. This is where we can look to go short, to sell on the next candle itself. Placing a stop loss where? Above the high. And then aim to take profit around or slightly before the support area. So this is where you can capture the swing in the market. So now, another way to trade the Gravestone Doji is in a trending market. So earlier was reversal. Now it can be a continuation in a trending market. So for example, if the market is in a downtrend, you can watch for it and wait for it to retrace, same example, to the moving average or to a previous support or resistance level. It can also be, say, a Bollinger Band. Essentially, any area that you identify as an area of value based on the characteristics of the pair and what price respects beforehand. So in this case, in this example, the area of value is back towards this swing high and towards this 50 period moving average. So now, there's another variation of the Gravestone Doji known as a shooting star. When you spot such candles, you can what? Consider going short. Place your stop loss above the swing high depending on your strategy, and you can exit either just below the swing low for a quick swing trade, or you can do what? A trailing stop loss technique. There's multiple ways to do it. One way is to use the moving average and then you keep trailing it, or any other method that you prefer. Now, the Gravestone Doji serve as an entry trigger. Not a lot of candlestick patterns serve as an entry trigger. As you go along, you see the way that we trade. We will always like to use price action, candlestick pattern, as a confirmation that bounces off area of value. So the Gravestone Doji is considered an entry trigger, which is why I say that this pattern itself is really powerful. So depending on how you trade, whether is it a swing trade, whether you are trend continuation, whether is it a reversal, right? That's where you can trade using this candlestick pattern. Now, we've covered the Gravestone, we've covered the Dragonfly. Now, third one is the Long-Legged Doji. So it's like what? It's like a regular doji, right? The standard ones that you see with the open and close at the same level. But in this case, both the upper and the lower wicks are really long. So imagine like a normal doji closing at the same level, but in this case, the highs and the lows are long. This suggests what? A lot more of indecision in the market itself versus a standard one. So now, this is a weekly chart where you see a long-legged doji, right, that's being formed. It often appears, not only, but often appears after a significant news release when the market reacts sharply, causing price to spike up and down. So this creates a candle with long upper and lower wicks. So trading directly off this pattern, it's pretty challenging because of what? Its wide price range. Which also means what we don't really like, setting a wide stop loss. So if you spot a long-legged doji, it's typically, not advisable to trade it directly on that time frame. So instead, you could consider this approach, right? That's where you can consider switching to a lower time frame. For example, now, like the daily chart. So after spotting this in this pattern, right, the long-legged doji in the weekly chart, now use the highs and the lows of the doji as reference point to identify buying opportunities or selling opportunities. So in this case, you see the highs and the lows of a long-legged doji, right, act as support and resistance in the lower time frame. So now, these levels would now provide really important, valuable reference points on your chart. Right, that's where you can establish what? Your entry point, your trading levels for your trade itself. So in this case, the market moved upwards towards the what? The area of resistance, which is the highs of the long-legged doji in the weekly time frame. Now it formed a bearish engulfing pattern that indicates what? A rejection of the lower prices. You can now enter a short position at the open of the next candle with a stop loss either above this high or the high over there. then you can aim to capitalize on the downward movement. So this is how you can trade a long-legged doji. Right now, another way to do it, if the market repeatedly tests the highs of the long-legged doji, and if it does, right, it indicates what? The buyers are willing to buy at these prices. So therefore, in such a scenario, there's a chance what? When price keeps testing and testing and testing, there's a chance the market could break out higher. So that's where you can consider trading what? A breakout above the highs as a potential trading opportunity. So now this level becomes a breakout trade. Generally, the market would test a level for the first time, especially with a strong move. The level tends to hold and the market reverse lower. However, if the market repeatedly tests and tests and tests the level over a short period of time, now there's a higher likelihood of a what? A breakout. So in this case, that's where you can trade the breakout above the highs as the strategy. Okay, so now let's do a quick recap. So number one, a doji candlestick pattern occurs when the opening and the closing prices are nearly identical, resulting in a small or non-existent body. So this indicates market indecision and can potentially signal potential reversal or consolidation in the price trends. Number two, the Dragonfly Doji suggests strengths as it signals rejection of lower prices. So it is similar to, what's the other pattern name? The hammer candlestick pattern. So that's where you can consider buying it when the market finds support during an uptrend, whether is it near a moving average, a support or resistance level, or Bollinger Bands, or anything that you define as a strong area of value. Number three, the Gravestone Doji indicates weakness as it reflects rejection of higher prices. You might consider what? Selling at where? Resistance levels, moving averages, Bollinger Bands, etc. Or any other area where selling pressure is expected. Number four, the long-legged doji is a what? It's a large candle on the chart itself. So instead of trading directly on that time frame, what do? Go one time frame lower to identify the resistance and the support level from the highs and the lows of the candle. So that's where you can look for trading opportunities based on the level that is formed on the higher time frame when you drop down to lower time frame for execution trades. So thank you so much for watching. If you enjoyed this video, please give it a thumbs up, right? It really helps to keep the channel growing. And if you are new here, don't forget to hit that subscribe button and turn on the notification bell so that you never miss an upload. So we also love to hear from you, right? Drop a comment below and let us know what you think or what you'd like to see next. I mean, your support truly means the world to us. It keeps us motivated to bring you awesome content every week. And if you're keen to learn more, I've created a free 5-part comprehensive training where I show you exactly how I trade using my lifestyle method. Link in the description below.